Okay. So we'll cover the PowerPoint. We're starting with chapter 20 and I'll take questions after that. So chapter 20 is about short-term financial planning. So this is the outline. We are going to discuss about forecasting short-term financial needs. We are going to discuss matching principle. We are going to discuss short-term financing with bank loans, short-term financing with commercial papers, short-term financing with secured financing, and we'll create a short-term financial plan. So learning objective for this chapter: forecast cash flows and short-term financial needs, understand the principle of matching short-term needs to short-term funding sources, know the different types of bank loans and their trade-offs, understand the use of commercial paper as an alternative to bank financing, use financing secured by accounts receivable or inventories, and know how to create a short-term financial plan. So before we start, I'll just give you a background what this chapter is all about. So I'll open an Excel. So this chapter is all about managing cash in short term, managing cash needs for a firm in short term. So if you distinguish, so let's say we are discussing Apple. So Apple has two types of needs in terms of cash flows, right? It has long-term needs. Long-term needs could be, let's say it's starting a new factory in India. It is moving its factory from China to India. So that could be its long-term financing need because the project will take a bit of time to do that, right? Short-term financing need would be, it has launched a lot of products this time and holiday season is coming, to having enough inventory for that holiday season. So that is short-term need. So holiday season inventory. So any company, so we are taking an example of Apple, but this is equally true for every other company in the world. Every company has long-term needs like building factories, creating new products, do research and development, and it has short-term needs. Short-term need means it would need inventory, it would need product to sell it, right? And most firms are seasonal, so demand is seasonal. There are very few firms that actually have same demand all throughout the year. Mostly consumer facing firms like electronics or anything, they have higher demands in holiday seasons or buying seasons, and they have average demands in every other season. So cash short term needs in terms of cash, they generally peak in certain months and then they are averaged out all across other months. Okay. So long-term needs we have discussed. You can take a bank loan for a long-term need. You can raise money through bonds, right? So there are different ways to raise money for long-term needs. We are going to discuss about short-term needs of company in this chapter. So we are going to figure out what is the cash flow projection, cash inflow projection. So what is the cash inflow the firm gets every month, and what is the cash outflow projection? Okay. So what is the cash inflow projection and what is the cash outflow projection? And if there is surplus, that is, if inflows are more than outflows, we'll invest this surplus. If there is deficit, that is outflows are more than inflows, then we'll raise money from outside, we'll borrow money from outside to fulfill our needs. So once again, short-term needs of a company are generally related to selling your product. So you need money to create inventories to meet the demand. So to find those needs, we try to create a projection for the whole year of whatever cash inflows we are expected to get and whatever cash outflows we are expected to have. From that, we either figure out whether we have surplus in the month, which we can invest for future needs, or we can use it to pay dividends or do cash flow and all that stuff, or there is a deficit. If there is a deficit, then we have to borrow. Now, how to make projections? So basically, inflow comes from two parts. Inflow basically comes from sales. So cash inflow comes from sales. Sales can be in current month. So sales that we are getting money from, they can be current month sales, that is cash sales, or they can be credit sales for previous months. Okay, so I'll write here previous months, and this can be credit sales. So you can either, so let's say Apple is selling some product. It can either sell it on a payment plan. So if you buy it through your carrier, so you buy it through Bell or let's say Shaw or any other player, you take a phone on credit. So the Apple is going to get going to get the payment in number of months, right? It's a payment plan. So sales from that will be credit sales. Some of that will be received right now. Some of it would be received in future months. Also, Apple may be able to sell the products right away on cash. I generally buy products on cash. So if I buy an Apple product, I'll pay cash to Apple and it gets it right away. So sales for any company, so in cash inflows for any company comes from sales. Sales can be current month sales, that is cash sales, or they can be previous month sales, that is credit sales. So based on that, we figure out what is the cash inflow. Now cash outflow is Apple needs to create those products. It will have marketing expenses. So all those expenses are cash outflows. From that, we figure out surplus or deficit. If we have surplus, we make investments. If we have deficits, we borrow. So with this background in mind, let's go to the PowerPoint and cover the concepts. Okay. So forecasting short-term financing needs. The first step in short-term financing is to forecast the company's future cash flows to discover whether you have cash surplus or deficit, and whether the surplus and deficit is temporary or permanent. If you can gauge that this deficit is permanent, you can borrow money, like you can borrow money in the long term and use it, because long term borrowings are cheaper than short term borrowings. So if you can gauge, or if you can estimate that, let's say Apple needs $100 million per month, right, in borrowing. So that's the base level borrowing. It may need more, it may need less, but that's the base level. So if you can estimate that, you can take a long-term loan, and whatever additional is required in the given month, that can be temporary. Okay. So for example, in the book, they have discussed cash flows for Whistler snowboards. Now, if you look at snowboards business, it generally happens in winter months. Now, winter months are either in Northern Hemisphere, so like US, Canada and Europe, or they are in Southern Hemisphere in Australia and New Zealand. But mostly the sales happen in North American markets and mostly in winter months. So our winter months, right? So based on that, demand will be higher in first quarter and last quarter. Demand will be weak in second quarter and third quarter. So Jan, Feb, March, the 3 months in winter, demand will be high. Same way, when the fall starts, the demand will be high. But the snowboard company will be manufacturing those snowboards all throughout the year. They will be manufacturing the snowboards all throughout the year, right? So we need to figure out what is the cash inflow the firm gets, what is the cash outflow the firm gets, and whether they have deficits or surpluses. So in the book you can refer it. Whistler is considered to be a profitable company. Net income is 500,000 based on current projections. Whistler will be able to fund projected sales growth from operating profits and accumulate excessive cash on an ongoing basis. Now, there are three reasons for short-term financing. There could be a negative cash flow shock. What is a negative cash flow shock? Something goes wrong in the business that you had not anticipated. Maybe, let's say it's a snowboard company. Maybe the machine that creates snowboards, it goes bad. So you have to replace it, or you have to hire a mechanic to do that. So something that is not anticipated may go wrong. For that, you need cash, right? Or it can be a positive cash flow shock. Positive cash flow shock means you had not anticipated it, but something positive happened. All of a sudden, your sales went up 50%, because everyone is staying at home and vaccine comes out. You had not anticipated it and the sales shoot up. So that's a positive shock. So it can be a negative shock, something goes wrong. It can be a positive shock, something that is not anticipated, but positive things happen. Or it can be seasonalities. We have discussed, like snowboard companies will generally do well in fall, right, in anticipation of winter and an actual winter. They won't have much sales in summer months and spring months. Okay, so let's discuss what is a negative cash flow shock. A circumstance in which cash flows are temporarily negative for unexpected reason. Firms will have to arrange for other financing to cover the shortfall. Okay, so something that is not expected, but it's negative. Positive cash flows. Increased expected sales often required increased short-term financing for items like marketing and production. Negative cash flow is created before the positive cash flow arrives, right? So generally increase in sales is an example of a positive cash flow shock. Or it could be seasonality. When sales are concentrated during a few months, sources and uses of cash are also likely to be seasonal. So they have given a table in the book. We have assumed sales occur uniformly throughout the year, but it may not be true. In snowboard manufacturing case, sales are likely to be seasonal, generally in winter months or in fall. So based on that, you create a cash budget. So what is a cash budget? It is a forecast of cash inflows and outflows on a quarterly or a monthly basis. Generally, it's done monthly in the industry. So you first forecast cash inflows. So assuming that snowboard company receives 70% of sales in cash, that is in the quarter that they are made, and 30% of sales comes from following quarter. So 30% sales are credit. So if you do sales right now, you will receive cash in the later quarter, and 70% are in cash. So you get money right away. So based on that, you have to make projections. So each month, 70% will come from sales of this month, plus 30% will come from previous months. Then you have to also forecast cash outflows. So what is forecasting cash outflows? Since Whistler produces a constant amount each quarter and sells seasonally, they pay a constant amount to suppliers each quarter. So generally spendings on selling, general and administrative expenses, taxes, interest, capital expenditure, all these are outflows. Now this is important. So in financing terms, we generally follow a matching principle. So what is matching principle? Matching principle means short-term needs are financed by short-term borrowings. Long-term needs are financed by long-term borrowing. Once again, short-term needs financed by short-term borrowing. Long-term needs financed by long-term borrowing. Then based on your needs, you try to estimate permanent working capital, the amount that the firm must always keep, right, to support continuing operations. For example, that snowboard company that we were discussing, let us assume it has 500,000 of permanent working capital. Permanent means the minimum sales will be 500,000. Minimum amount of money required per month will be 500,000, or per quarter will be 500,000. That is permanent working capital. Now there will be flux working capital, that is temporary working capital. The difference between actual level of investments and the permanent working capital is called as temporary. So some working capital, some cash demand will be the baseline demand. Then in the month that sales are good, you will have higher demand. Now, why it is important to distinguish between baseline demand, baseline cash demand, and additional cash demand, let's say, it is important because baseline, you can use long-term financing to finance it so that your borrowing cost is low. And you can just use like short-term borrowing for additional working capital. Now, there are two financing policies that a company can follow. Aggressive financing policy, financing part or all permanent working capital with short-term debt, right? It has funding risk because interest rates can go up. If you're borrowing for a short term, you need to roll it over. Every few months, you need to keep on borrowing. So the cost can go up for that. So that is not a good policy to follow. It is better to estimate your permanent demand and borrow it in long-term market, and whatever additional money you require, you borrow it in short-term market. So this policy is not that great. Conservative financing policy, financing short-term needs with long-term debt, but it can result to non-productive use of cash. Sometimes the demand may be weaker than your projection. So in that case, you may be having surplus cash that has no use. Okay. Now, how do you borrow? So first way to borrow is if you have a deficit, if you need money, how to borrow that? So first way of borrowing is financing with a bank, right? You can have a promissory note. So single end of the period payment loan. So I'll explain how that works. So let's say I have a t-shirt business and I'm anticipating a lot of demand in the holiday season. Christmas is coming up. I have an online t-shirt business. I make funny t-shirts and I'm anticipating a lot of demand is going to come in because of the holiday season. So I need $100,000 to fund that demand, to create the product so that people can order. So how will I do that? So I can borrow it with a bank with a promissory note. So what is a promissory note? I'll borrow 100,000 right now. So this is borrowing. Okay. So let's say I'm borrowing for 3 months. I'm borrowing for 3 months. So I'll borrow right now, right? And in 3 months, after 3 months, I'll pay. What I'll pay 100,000 plus interest. So promissory note is a one-shot borrowing. How is it one shot? You borrow right now, right? And when it matures, when the maturity comes, you pay 100,000 plus whatever interest is there. So let's say interest is 3% for 3 months. So you will pay 100,000 plus 3% of 100,000. Okay, so you will pay 103,000. One extra zero here. So you'll pay 103,000. So you'll pay 100,000 plus 3,000. Okay. Now in exam, right, they will ask you before that. Now what is this interest dependent on? Now this interest, how banks really charge in Canada. I run a small business, so I'm aware of that. So interest is generally prime rate plus some spread. Prime rate plus some spread. So prime rate is the rate that the bank charges to its most trustworthy customers. Prime rate is rate that the bank charges to most trustworthy customers. So let's say RBC has 2.2% as the prime rate. So it will charge me 2.2% plus certain spread. So this spread can be 3%. So it will effectively charge me prime rate 2.2 plus spread. Spread is because I'm more risky than RBC's best customers. Okay. So in Canada, we use prime plus spread. If you're looking at London, it uses LIBOR plus spread. Okay. LIBOR is London Interbank Exchange Rate. So if you're based in London or European markets, they generally use LIBOR plus spread. In Canada, we generally use prime rate plus spread or certain benchmark plus spread. Mostly it is prime rate plus spread. So interest that they will charge you depends on prime rate that is going on in the market plus a certain spread. And you can search this prime rate out and it keeps on changing. Prime rate RBC. So it is 2.45. This keeps on changing. It is a market rate. Now, one question would be, can you borrow below prime rate? Generally, whenever you are doing long-term borrowing, you can even borrow below prime rate. So if you have been a good customer with RBC, they may give you discounts on prime rate. It is relatively rare, right? Because it's the banking is very, like there are few banks and it's very monopolistic in Canada, but they can even give you discounts on prime rate. So your borrowing rate can be lower than that. But generally it is prime rate plus certain spread. Now, in exam, they will ask you to calculate effective annual rate. Okay. So effective annual rate on your borrowing. They will ask you to calculate effective annual rate on your borrowing. So how to do that? So step one, find the borrowed amount. Okay. Step two, find the final payment. So find the borrowed amount, find the final payment. Step three, calculate the rate of interest charge. Okay, calculate rate of interest charge. How to do that? So it will be final payment divided by borrowed amount minus 1. Okay, formula for that, final payment divided by borrowed amount minus 1. This was step 3. Step 4, calculate effective annual rate. Calculate effective annual rate, that is 1 plus rate charged, 1 plus rate charged to the power 12 divided by months, right? Number of months the rate was charged for minus 1. So effective annual rate is calculated as 1 plus rate charged, that is step 3, to the power 12 divided by months minus 1. And I'll put this in brackets. So let's do few examples so that you can understand. These are the steps. So let's say I'm taking a promissory note loan. I'm taking a promissory note loan. I'm taking any loan, right? In which I'm borrowing 90,000, okay, 90 grand for 4 months. I'm borrowing 90 grand for 4 months, and I'll pay back 97 grand. So I'm following 90 grand for 4 months, and I'll pay back 97 grand. Any questions? Okay, so if you have any questions, put it in the chat. So what is happening? I'm borrowing 90 grand for 4 months and I'm paying back 97 grand. So they are asking us to find effective annual rate. How to do that? Follow the steps. Step 1, find the borrowed amount. Borrowed amount is 90 grand. Step 2, find the final payment. Final payment is 97 grand. Calculate rate of interest. So let's do that. Rate of interest is 97 payment divided by borrowed amount 90 minus 1. 97 payment divided by 90 grand borrowing minus 1. So it is 7.78%. Now calculate effective annual rate. How to do that? 1 plus 7.78% that we calculated, 1 plus 7.78% that we calculated to the power 12 divided by 4, to the power 12 divided by 4. Okay, 12 is total number of months in a year and 4 months is the total borrowing that you have done for. You borrowed it for 4 months. That's why I put 4 in the denominator, minus 1. So your effective borrowing rate for the year is 25.2%. Your effective borrowing rate for the year is 25.20%. So let's take one more example. So you're borrowing 47 grand, you're paying 50 grand back, and you're borrowing for 6 months. You're borrowing for 6 months. So I'll give you 2 minutes to do it, right? Try it out and then we'll discuss. You have to find out effective annual rate. Follow the steps. Okay. So let's follow the steps and let's do it. Step 1, find the borrowed amount. Borrowed amount is 47. Step 2, find the final payment. Final payment is 50. Step 3, calculate the interest charged. Interest charged is 50 divided by 47 minus 1. 50 divided by 47 minus 1. Okay, 6.38. Then calculate the effective annual rate. So 1 plus 6.38 to the power 1 by, sorry, 12 by 6. 1 plus 6.38 that we calculated to the power 12 by 6. That's how to do it. So effective annual rate is 13.17. Effective annual rate is 13.17. Any questions regarding this? All right. So promissory note means there is a single end of the period payment loan. So payment is generally based on prime rate or LIBOR. So second type of borrowing could be line of credit. Line of credit is a credit line is extended to you, and you, whatever you borrow from that credit line, they will charge interest on that amount. So if you do not use your credit line, they will not charge interest on that amount. Whatever you use, they will charge on that. Now, lines of credit can be uncommitted. Uncommitted means the bank is orally saying, or they're giving you $100,000, but they can take it back. So if they want, it's not a committed amount. It's not a blocked amount. So whatever line of credit they extend, if the bank is in trouble, they can take it back, right? Committed amount means if they give you a credit line, they cannot take it back. So they sign an agreement where they cannot take back the credit line. So that's a committed line of credit. Now, whenever there is a committed line of credit, generally they charge you fees. Fees can be in two ways. They can charge you upfront fees on whatever credit line they extend, right? Second, they can charge you fees on unused credit. So whatever unused credit is there, so let's say they extend you 1 million credit line and you use only 800,000 out of it. So 200,000 is unused credit. So they may charge you fees on unused credit too. Okay. Then it can be a revolving line of credit. So it is a credit line that is extended for multiple years. Each year it is renewed. Or it can be evergreen. So it can be more than multiple years. Next, you can also take a bridge loan. Bridge loan is often a discount loan. Discount loan means you borrow money and you pay back in a lump sum fashion. So you borrow $100,000, you pay back $103,000. So that's an example of a bridge loan. Bridge loans are generally taken when you know that there is some money coming, but you need money right now. For example, Airbnb is coming up with an IPO, but it took a bridge loan some few months back. So why did it take a bridge loan? It needed money, but it knew that it's going to do an IPO in few months. So there is a big money coming in from that. So it wanted some financing to be done. So it took a bridge loan. So whenever money is going to come, in the meanwhile, you can take a bridge loan. Often discount loan with fixed rate of interest. With discount loan, borrowers pay interest at the beginning of the loan period. Okay. Common loan stipulations, there can be, so these are the fees that are charged. So there can be commitment fees. So if a bank is committing you certain amount, so they may charge you fees on that. There can be loan origination fee. So if they're giving out loans, so they may charge you processing fees and all that stuff. So that is loan origination fee. Or they may ask you to keep certain balance with them in a non-interest paying account. They can ask you to keep certain balance with the bank in a non-interest paying account. So they have given an example. So commitment fees, example, 1 million committed line of credit is extended with 10% interest and 0.5 is charged, right? Is the committed fee charge. Firm borrows 800,000 and repays at the end. So what is commitment fees? Commitment fees is the fees charged. Commitment fees is the fees charged on the unused portion of the loan. On the unused portion of the loan. So you're using 800,000. on which you will pay 10% interest. So you will pay $80,000 as interest, 10% of 800,000, 10% of 800,000. Plus there is a commitment fee. So whatever loan you have not used, you have to pay 0.5% on that. So 0.5% of 200,000 you will pay. 200 is the unused component. 1 million minus 800, that is 200,000. So on that 200,000, you will pay a commitment fee of 1,000. So 81,000 is the total amount. Okay. Then there can be a loan origination fee. So example they have given. So Towel and Diaper Services is offered a 500,000 loan for 3 months at 12% with a loan origination fee of 1%. What do we mean by loan origination fee? So whatever loan amount is given to you, that fee is subtracted from that. That fee is subtracted from that. So loan origination fee is charged on the principal. So fee is 0.1% of 500,000. So 5,000. So instead of 500,000, $500,000, you actually get only 495 because loan origination fee is subtracted from the loan extended to you. So loan origination fee was 1%. So out of the 500,000 that is extended to you, 5,000 they will take. So you'll be extended only 495,000. The interest paid for 3 months is 500,000, right? Interest paid for 3 months is 12% into 500,000 divided by 4, because 12% is the yearly interest. You are charged interest only for 4 months. So 15,000 is the total interest. So how will the cash flow look? So you're borrowing for 3 months. You will get 495,000. You will get 495,000, right? And you will pay 500,000 principal plus 15,000 interest. So you borrow 495 and you pay back 515. You borrow 495 and you pay back 515. So 3 months interest is 515 divided by, so they are calculating effective annual rate. So the steps that we used. So borrowed amount is 495. Okay. Paid amount is 515. And we are going to calculate effective interest rate. So how to do that? So calculate the interest charge, that will be 515 divided by 495 minus 1, and then calculate effective annual rate. How to do that? 1 plus 4.04% to the power 1 plus 4.04% to the power 12, number of months in a year, divided by 3. You're borrowing for 3 months. And minus 1. So it is 17.17. So this is how you calculate effective annual rate. Any questions? Okay, so let's continue. Sometimes they may charge you compensating balance. So you may have to block your money in the bank for the given time period. So Towels and Diaper Services is asked to keep 10% of the loan principal in a non-interest bearing account with the bank. The loan was 500,000. So it means Timmins must hold $50,000 in an account at the bank. Thus the firm has only $450,000 to use. Okay. So whenever a balance is to be kept, how to do that? 500,000 is extended to you, but you have to you have to block $50,000 of that in a bank. So actually you're given only 450,000. And how much do you have to return? You have to return 515, that is principal plus interest, minus 50,000 you already have with the bank. So you have to return 465. Okay. Then you can calculate effective annual rate. So it is 3.3%. So sometimes they ask you, they give you like fixed commitment amount. Sometimes they give you origination fees. Sometimes they give you bank balance requirement. So how to do bank balance requirement? So you're borrowing 500,000, but $50,000 out of that, that is 10%, is to be kept with bank. So you will actually only get 450. Now when the loan matures, you already have $50,000 with the bank and you have to pay 515. Okay, 500,000 principal plus 15 interest. So you actually have to pay 465. Then you can follow these steps to find out interest rate charge and effective annual rate. Okay. So they've shown method of calculating effective annual rate. So once you calculate the interest charge, use effective annual rate formula that we have used to convert it. Okay. So one other way of financing is taking a commercial paper. So commercial paper is, you're not raising money from banks. You're raising money from investors. Instead of raising money from banks, you can raise money from investors. They may charge you a little lower interest rate than the bank. Okay. So commercial paper is the debt market. You get access to short-term debt market and you can raise money. So commercial papers are generally short-term unsecured debt used by large companies. They're usually cheaper than short-term bank loan. Minimum value, face value is 25,000, maximum face value, most have face value of 100,000. Interest on commercial paper is typically paid by selling it at discount. So you invest certain money and you pay back certain money. So that is how commercial paper works. Generally, commercial papers can be direct papers. The firm sells directly to investors, or it can be dealer papers. They sell it to the dealer and then dealer sells it to investors. So dealer sells investors in exchange for a spread. So they buy it from the company. So a dealer buys from the company and then sells it to an investor for a spread. Spread decreases the proceeds received that the issuing firm receives, increasing the effective cost. A firm issues 3-month commercial paper with a face value of 100,000 and receives 98. What is the effective annual rate? We have done this multiple times. So borrowed amount is 98, paid back amount is 100. The borrowing is for 3 months. So you can try it out. 98, 100, 3 months. Calculate the interest rate first. So 100 divided by 98 minus 1, and then so 100 divided by 98 minus 1, so 2.02, and then use formula 1 plus 2.04% to the power 12 by 3. So 12 by 3. Why 3? Because you are borrowing for 3 months. So it will be 12 by 3, that is 4. So it will give you 8.42 effective annual rate. Next, the finance manager needs to know the effective annual rate of all firms' funding sources to be able to make comparisons across them and choose the least costly way to finance short-term needs. Okay. So loans that you take from the bank can be unsecured loans or they can be secured loans. So what are secured loans? These loans have collateral with short-term asset. So whatever inventory you have, generally that is kept as collateral. Usually account receivables or inventory is kept as collateral. So whatever money you're going to receive from customers, those sales receipts are kept as collateral. So if you do not pay, bank can recover that money from customers, or inventory can be kept as collateral. So in case you don't pay, the bank takes over your inventory. Most common sources are commercial bank, finance companies, or factors. So these are venture firms that purchase the receivables of other companies. Okay. Now, account receivables can be kept as collateral. So what are account receivables? Whatever product you have sold to customers on credit, that is account receivable. So customers have already bought the product, they're going to pay you in some time. So they're either going to pay you in a payment plan or they're going to pay you after some months. So that account receivable, you can keep it with bank as a collateral and borrow money from them. So lender reviews the invoices and decides which credit accounts it will accept as collateral and based on its own credit standard. So banks will study those receipts. It will accept whatever receipts it can use and give you money against that. Or they may be doing factoring. What is factoring? Factoring means instead of keeping it as a collateral, you sell it to the bank. So generally this is used by car dealership. So whenever a car is sold, you borrow money from the financing company. So you do not pay the car dealer. You pay financing company that amount. So car dealer is selling that sale to the bank. So bank is going to collect money from customers rather than the car dealer. Okay. So firm sells receivable to the bank or lender. The lender pays the firm the amount due from its customer at the end of the firm's payment period minus certain fees. So whatever the bank gets out of that, it will keep on paying the dealership. Then you can keep inventory as a collateral. It can be a floating obligation or a blanket obligation. All inventory is used as collateral, or it can be trust receipts or floor planning. So inventory items are held in a trust, in a separate trust, right, as a security for a loan. Or it can be a warehousing arrangement where inventory is kept as collateral in a separate warehouse and then bank gives you the money against that. So Roe Canary wants to borrow $2 million for a month. Using its inventory as collateral, it can obtain a 12% loan. The lender requires that it is to be kept in a warehouse. The warehouse fee is $10,000 payable at the end. Calculate the effective annual rate. So what is happening? You're borrowing $2 million on which you will pay 12% interest yearly. That is 1% interest per month. Okay. And you will additionally pay $10,000, okay, as a warehousing fee. So 1% interest you will pay, right, and you will pay $10,000. So how will it look? $2 million you borrow, you pay 1% interest on that, so $20,000 interest you pay plus the principal plus warehousing fee. So in total you pay $2.2 million and $30,000. You pay $2 million and $30,000. We follow the steps. 2.2 million 30,000 divided by 2 minus 1, 1.5%, and 1.5% divided to the power 12 by 1 because you are borrowing it for 1 month. So that will give you effective annual rate of 19.56%. Any questions? Okay. So putting it all together. So again, bottom line, forecast your cash outflows, forecast your cash inflows. If you have surplus, we invest it. If we have deficit, we finance it. So due to seasonal sales, there will be wide swings in forecasted cash flows. Analysis identifies two decisions: what to do with excess cash if you have, and what to do in terms of financing if you have any deficit. So that's it for the chapter. I'll stop the recording. I'll open the floor for questions.